Hello everybody. Firstly, I'd just like to welcome you to this webinar where we'll be talking about the non-farm payrolls and the opportunities its publication will present. My name is Sasha and I'm a financial analyst from the research department at Fortrade. I'm delighted to have you with us, and if you have any questions, please call us and ask to speak to a senior account manager who will be happy to help. Before I go any further, please take a moment to read our risk warning and disclaimer. I'm sure you know that although gains can be made through trading CFDs, losses can be incurred too, and you need to be aware of this. And now let me explain what a market opportunity is if you don't know. A market opportunity is a one-page briefing containing market analysis, and our goal is to provide you with a simple to understand opportunity to trade in the markets. We will select an instrument such as gold or a currency pair and tell you our very best estimate on its price direction so that you can trade on it if you want to. Market opportunities are produced by the research department on a daily basis according to market conditions. A market opportunity consists of fundamental analysis, geopolitical events, and technical analysis that includes a pivot point and support and resistance levels. It's important to understand it's your decision whether you want to trade on market opportunities or not. Here is an example of a recent market opportunity. You can see fundamental analysis on what's going on with the euro-dollar currency pair. You can see this is a downtrend opportunity over a weekly period, since our analysis suggested that the euro would decline in value against the dollar. At the top you can see some geopolitical events on the left-hand side and fundamental analysis that can influence the euro-US dollar currency pair. For example, the part on the trade war, stating that the US dollar acts and benefits as a safe haven asset when trade war tensions increase. Or the situation in Italy, which has affected the euro. When using a market opportunity, it's vital to look at the pivot point on which the calculations are based. In this instance, if the price reaches 1.16906 that you can see on the right hand of the screen here, this shows the right moment in our estimation for opening a trading position if you decide to trade on this market opportunity. You can see below the trend direction and the time period. It's also important that you know how to use the stop loss and take profit options. You have support and resistance levels further along. At these points you can put a stop loss and take profit. You can see below the trend direction and the time period. It's also important that you know how to use the stop loss and take profit options. You have support and resistance levels further along. At these points you can put a stop loss and take profit. And further down you have calculations on the right hand side. If you close the position using take profit, you can expect these kinds of profit at those support levels in green. If the price is going against you, then you can potentially have a loss of this amount at these resistance levels in red. Finally, profit and loss calculations are based on a one-lot trading volume. So why is the NFP important for the financial markets? The non-farm payrolls report is the release of data on US jobs growth over the previous month, and it's published by the Bureau of Labor Statistics, usually on the first Friday of the month following the data. It's the most eagerly awaited monthly data by world markets. Morning trading volumes are usually quite slim in European markets on the day of the release, as they await the afternoon release time. The headline number in the report gives the number of jobs that the US economy has gained or lost over the previous month. A more important number for the markets, however, is the difference between the actual change and the consensus of estimates by analysts and economists published in advance. The market reaction will depend on whether the published figure is above or below the consensus, and by how much. Over the past few years, non-farm payroll data has been very positive, but NFP estimates have failed to meet expectations more than 6 times over the past year. Last month's figures were above expectations, as I will explain further in a moment. As you can see here, the unemployment rate has significantly improved in recent years. The unemployment rate approached 8.5% during the financial crisis, but has fallen since. Since March 2017, the unemployment rate has dropped from 4.5% to its current rate of 3.9%. Average hourly earnings is important since an increase in the figures indicates a possible rise in inflation and in the value of the dollar, while a decrease in AHE tends to push the dollar down. Month-on-month, average hourly earnings were 0.4% in August, and on a year-on-year basis, the number was 2.9%. So, the NFP release comes together with the unemployment rate indicator on the first Friday of every month. When this is due, the trading week is a range-bound one for the forex market, and after the release, traders start positioning for the next time the Fed meets to see how monetary policy changes in the meantime and how to react. When the actual number differs from the forecasted one, the market travels. Usually, traders try to take positions for the NFP in advance by looking for clues from other economic data, like the ADP jobs report or private payrolls. It's believed that private payrolls and the NFP data are linked in a directly correlated fashion, but this isn't always the case. The unemployment rate is part of the Fed's decision-making process to move on interest rates. As a rule of thumb, lower unemployment rate is better for the economy, as jobs are created, and this could result in the Fed hiking rates. Higher rates lead to a higher dollar. There is no such thing as full employment in an economy. By the time the unemployment rate has fallen to below 4%, a labour shortage has already appeared. Experienced traders know this. Forex trading is about anticipating what the central bank is going to do with interest rates at the next meeting, and the NFP is the perfect economic release to position on the right side of the market. Non-farm payrolls released on September 7, 2018 show that the US economy created 201,000 new jobs in August, better than the predicted estimate of 191,000 jobs. The jobless rate increased to 3.9%, which was worse or higher than the expected figure. The US dollar index grew by 0.19% following the publication of the release on September 7th. On this graph, we can see the reaction of the market upon the release of last month's NFP report. As already discussed, the unemployment rate was higher than expected, and the NFP produced better than expected figures. Average hourly earnings was at 0.4%, better than the expected 0.3%. The markets were pleased both with the NFP and with average hourly earnings, which helped to confirm the necessary economic conditions for a further interest rate rise in December, and for an immediate rise that occurred last week. As far as the euro-dollar is concerned, by close of business on September the 7th, the currency pair was down 0.25%. There was a reversal as the euro climbed, supported by economic data, but by the end of the trading day, the pair closed down. The thing to remember is that the dollar is often volatile on the day of the NFP, but that the NFP can also represent a good trading opportunity. So, what can we expect from this week's report? Well, economists expect that this NFP will record that 185,000 new jobs were created in September, and that the unemployment rate will go down to 3.8%. Traders would also be advised to keep an eye on the average hourly earnings figures. If they are above expectations, it may push the dollar higher. Average hourly earnings are considered a sign that inflation will rise, and if inflation rises, there is a greater chance of interest rate hikes. A fourth rate hike this year will likely take place in December, with the CME Group estimating the probability of such a rise at 78%. This position is opposed by President Trump, who favors lower rates, but the president isn't likely to be able to exercise political influence on the Fed. In recent weeks, the dollar has been trading in slightly lower ranges. However, the dollar continues to be powered by a strong economy and the prospect of an increased pace of interest rates. So, it is certain that reports like the NFP can have a major influence on the greenback and the financial markets. Another factor to bear in mind, if you are trading the dollar, is the trade war. The dollar has functioned as a safe haven currency, as many investors believe the US is in a better position to ride out a trade war than other countries. So, if you are looking to trade the NFP as a short to medium term move, you should consider that as trade war tensions increase, the dollar tends to increase in value against other currencies. On the other hand, if you believe there will be an end to the trade war sooner rather than later, this scenario would likely influence the dollar downward against other currencies. Of course, we at 4Trade will be following any developments that affect the markets very closely. So please do get in touch with the Senior Account Manager if you have any questions or want to take advantage of the trading opportunities that this event will present. Until then, goodbye, and please join us again at 4Trade soon.